Welcome back. Long time no see. This is our final session of our what was once a 1 week board meeting, but now is 1 week plus a day. But we gave back Friday, so we took back today. The discussion, the topic for this final session is sustainability assurance, and as you know, that we made a real commitment to address sustainability assurance as part of our work plan that we approved that's going to the PIOB for their approval. So the goal today, as I've said, is agreeing what are the most impactful things that we could do to serve our stakeholders and meet our public interest obligations, which include encouraging the consistency and high quality assurance of sustainability information. So today we're gonna have some input from a number of guest speakers, and then we're gonna go into working groups, to breakout groups, to help formulate recommendations that we could give to this sustainability assurance consultation group and the board more generally, which will then inform our project plan in this area. So we'll begin today. We're welcoming back the European Commission as one of our official observers, Elena Aviris, from the Commission, who will give us an update on some of the activities in Europe. After that, we'll also have 3 additional presenters who will join us sometime between now and 4 p.m. and we'll do a formal introduction of them shortly when we get to their point. Elena is going to, as I said, discuss a little bit of what's in the European Corporate Sustainability Reporting Directive. She's been working in the unit dealing with corporate reporting, audit, and credit rating agencies at DG FISMA and the European Commission. Since the publication of the Commission's action plan on sustainable finance in 2018, her field of expertise has included sustainability reporting, working in different policy-making initiatives, such as the revision of the guidelines of sustainability reporting with regard to climate information, and of course, this recent proposal. So we're thrilled, Elena, to have you with us today. We really have enjoyed working with the Commission over recent weeks, and we look forward to hearing what you have to say.
Thank you so much, Tom. Thanks for the introduction and thanks for the invitation. I'm going to try to summarize 10-15 minutes where we are right now with this proposal, and especially, of course, touching on the most important points to this group, which is assurance. So first of all, if we go to the next slide, in terms of process, the Commission put forward a proposal last April that basically reviewed the current non-financial reporting obligations in the EU. They were considered very high level, not specific enough, and this also in a way made a bit difficult the assurance of this information. Even if this was not a requirement, some companies wanted to do it voluntarily, and 3 member states in the EU decided to impose the assurance of sustainability reporting. But as I say, the requirements as such weren't very prescriptive. So also in terms of comparability or of checking compliance, the exercise was probably a bit difficult for auditors and for supervisors. But in any case, we assessed that there were issues with the way in which reporting was conducted by companies. The information provided wasn't reliable or comparable, relevant enough, and therefore we conducted an assessment and we decided to update the requirements. So long story short, the proposal was put forward last year. It is being negotiated by co-legislators at the moment. So this means that we have something that the Commission has proposed, but until hopefully June this year, we won't have the final legislation. And of course, this means that some aspects may change. I'll touch upon the specific aspects as regards assurance in a moment, but just to keep in mind that, of course, this is a moving target and we cannot anticipate every single aspect because co-legislators are discussing at the moment. The main aspects of the revision are the requirement of the use of European reporting standards, the extension of the scope to more companies, the obligation to locate this information within the management report, which is also important in terms of assurance, because for the extent that it needs to be identified which parts correspond to reporting on sustainability according to these standards, so that the auditor or the third party can really look into those parts in a more detailed manner. And then also provisions about digitalization to make the information machine readable, and of course on assurance. So right now there is an obligation to verify the information. We'll come that in a moment. But this is just a big overview of what are the big changes that the proposal is putting in place. I'm gonna touch a little bit on standards and of course then move directly to assurance. Next slide. Or it's not working. There you are. Thank you. There will be standards for large companies that will be mandatory, of course. And then there will be standards for SMEs, because listed SMEs will be in scope. And they will have a lighter regime in terms of the reporting content. So those SME standards adapted to their resources, capacity, circumstances. And also they will have a 3-year delay in the compliance with the requirements. So they will have 3 more years to start reporting. So this in terms of standards, because of course, in the end, the auditor or the third party will check compliance against these reporting standards. Next slide, please. And then moving to assurance, which is, of course, the most important topic here. The proposal would require limited assurance engagement for sustainability reporting, and will transition to a reasonable assurance engagement requirement the moment the Commission adopts assurance standards suitable for reasonable assurance. So in the Commission proposal, we do not set a deadline for the adoption of these assurance standards. We do not set a deadline, therefore, for the transition towards reasonable assurance. However, it's important here to mention that, again, co-legislators are discussing all this. The Parliament, for example, has proposed that there is a deadline fixed already for the adoption of standards for limited assurance, and there will be a deadline fixed for the adoption of standards for limited assurance as well. So both for limited and reasonable, there would be fixed deadlines in the law. This, of course, is maybe the most relevant input that I can give you today to inform your discussions, because, of course, the reason why we didn't set ourselves a deadline was the lack of available assurance standards that we thought would be fit for purpose to take directly off the shelf, and especially given that we didn't have at the time the European reporting standards, because, of course, in a way, they will influence the level of detail of these assurance standards or some aspects of these assurance standards. So we left it very open. We didn't specify which assurance standards the Commission would adopt. It would literally be a Commission legislative act. So in a way, it would be a product from the Commission. We wouldn't be forced to take a specific standard from the IAASB or from whoever else, but we have the freedom to do so. So it's really not constrained. It's really open, and this was done indeed on purpose to give time to see if any actor wanted to work a bit on this topic, and also, of course, when the time came, coordinate with the COB and see what could be, taken as basis or as technical input, etc., etc. So this is especially relevant, and the outcome of the negotiations is going to be quite important, because if we are given a very tight recording stopped. Okay, if we are given a very tight timeline for the adoption of the first set of assurance standards, so the standards for limited assurance, then would basically need to hurry a lot and see how we manage and what would we manage to put together for that first adoption. So these upcoming 2 months are going to be very intense, and they're going to be critical in understanding what will the legislation look like in the end, and how much time we'll have to adopt the first set of assurance standards, because as I say, it can be very tight, or it may be 5 years' time. We don't know that yet. In terms of the person who would provide this opinion, the legislation, the proposal envisages that the statutory auditor gives this opinion to ensure this connectivity between financial reporting and sustainability reporting, but it also allows member states to allow other third parties give this opinion. This is also an aspect that may change slightly during negotiations. We'll have to see. It might be that member states end up being obliged to allow other third parties instead of being an option for them. But again, this we'll have to see in light of the negotiations process, which is going to start next week. So we cannot know yet. And this is basically the biggest aspects in relation to assurance that are most relevant. As I say, the negotiations between the Council and the Parliament, which are the two co-legislators at EU level, the two institutions, will start on Monday. And they expect to reach an agreement by June. So we can keep in touch, as we've discussed previously, to keep you updated with these developments to the extent that we have any information, because of course, until the end of the process, nothing is final. But as I say, there are very big chances that the kind of work that you may decide to do on this is useful for us. And then again, it will depend on the what and the how and the when. And of course, probably it's very important that the contact with the COIB is always kept, indeed, to coordinate and see what are the aspects, to say it like that would be more important in our European context. Also, as I say, in light of the reporting standards that will only be ready later this year. And therefore, in a way, if we have to take a bit of a sequencing approach, this is also a bit of a timing issue for us. But again, we'll have to see how the negotiations go, and we'll have to see whether a final deadline is set, and if so, when is this deadline? Thank you. I'm happy to comment on any of these points a bit more in depth or to take questions.
Thank you, Elena. That's really helpful for us, for our discussions. I'll let, does anyone have any questions for Elena? Maybe while we wait for questions. So I know that the Commission will be responsible for reasonable assurance standards and determining what would be appropriate for that. Our ISA 3000 considers both limited and reasonable, but from an EU-wide perspective, does this suggest, from your standpoint, particularly with your timeframes, that you're more focused on the availability of reasonable assurance standards?
As I say, it's very difficult to tell, because we cannot really know the outcome of this negotiations process. We know the Parliament wants to set a deadline for the adoption of standards for limited assurance. So they want that. During the Council working groups, that we call them, before the negotiations start, when they put together their common position, some member states in the Council also raised, the issue of, well, the earlier we have standards adopted by the Commission on limited assurance, also the better, because then we have an homogeneous approach, etc. So it's very difficult to anticipate whether this will fly in the end or not. It has chances. So there are chances that they agree on a deadline for standards for limited assurance, and there are chances that this is not too far away in the future. Again, it's difficult to tell now, because we don't know the outcome of those discussions. But in any case, we'd also be interested in adopting standards for limited assurance if they were available, because of course, until the time when the standards for reasonable assurance come, that would also bring guidance to auditors and homogeneity in the way the opinion is provided. So it's in our interest as well to do so. We just want to get it right. So I'm sorry, but I cannot really, say more on this one or more on that one, because first, let's see what they decide, and second, it would be good in any case to have something as soon as possible.
Thank you. Josephine, maybe it would be good if anyone has a question also to just say where you're coming from too. I think that would be helpful for Elena. Josephine?
Hi, Elena. I'm Josephine Jackson. I work for the Financial Reporting Council in the UK. And actually, I head up our FRC ESG climate group. So obviously very interested to hear what's happening in the EU. I just have a more technical question in respect to the ability of the statutory auditor and the proposal that the statutory auditor will be delivering the assurance service on that part of their engagement of the audited entity. And you had a little reference to the fact that changes would be made to the audit directive. Could you just give us a little bit more information on where you see that might be and if that's hitting our ethical standards side as well? Thank you.
Sure. Indeed, I can elaborate a lot more on that one. So the idea of the proposal is to require that all auditors acquire the necessary expertise in the assurance of sustainability reporting in terms of examination, practical training, everything. And then also that, of course, the supervisory regime, the requirements on independence, objectivity, that everything kind of extends to that exercise as well. So those are the changes that are in the proposal. During negotiations, these may change. I mean, if you see, for example, the council position, the approach they suggested is to make it an option for the auditor to have this extra qualification to do this or to give this opinion. So thank you, to give this opinion. So they can decide whether they want to qualify, undertake all those examinations, etc., and then be able to give that assurance and sustainability reporting. The reasoning behind is to avoid further market concentration, because if the access to the profession is so difficult, if auditors maybe or people decide not to become an auditor because they have to go through so much work and so much burden, then maybe the market gets even more concentrated because there is less people. So there are these changes in the council position. Let's see how Parliament would react to that. But in one way or the other, what's clear is that the person that would give this opinion would need to have the skills and would fall under the framework of the audit directive. For third parties, what the proposal says is that the member state needs to set up a framework that is equivalent to the one of the audit directive in a way. So for those third parties, they need to ensure that they have the skills, the expertise, that they meet requirements on objectivity, that there is a proper supervision, etc. But it's kind of left to member states to decide how to do this. The principle is in the law, but there are no specifics. So this is more or less how the personal requirement of who does what is envisaged in the law.
Thank you. That was really helpful. Thank you.
Lynn?
Thank you very much, Elena. That was really interesting. I heard from you from that presentation that two things are really important for you: limited and reasonable assurance and who does the audit. I was wondering what other issues you've heard about in terms of assurance, and what might be some of the other matters that you've heard spoken about that we should take into account in planning our work.
Sorry, I didn't understand quite well the question. What are the measures in terms of changes to the proposal or aspects of the proposal?
No, what other things do you think we should take into account other than what you've mentioned?
I think the most relevant issue is the need that we'll have very soon to adopt standards. And of course, the more input that you can provide, the more we can use and assess whether it's useful for us, whether it serves the purpose. So the issue of maybe having a fixed deadline to adopt limited assurance standards, And certainly, because this is very, very, very likely, having a deadline for the adoption of reasonable assurance standards, those are the two key aspects. Maybe also the consideration that two different categories of actors can give the opinion, so the auditor, but also a third party. And maybe also the consideration that this will be within the broader management report. So again, in this, I mean, of course, the council suggests that this is in a separate section so that it also facilitates the assurance, etc. We've always argued that this is not a must. I mean, of course, it makes the life of the auditor easier, but as long as it's identifiable and clearly, you know, explained where it is, table, whatever, it shouldn't be an issue. And we still wouldn't like to constrain the freedom of companies to evolve a bit in this issue and see how they want to talk about these matters. But okay, to be seen during negotiations. But in general, the fact that it's in the management report, it might be useful for you to consider as well. And then, of course, but this, I mean, I'm just throwing ideas, and of course, you'll take whatever you want. But of course, to us, the content of the reporting standards will be key, because the reporting requirements are under a double materiality perspective, which not all jurisdictions or other jurisdictions will have. And they would cover also all ESG matters. So these are aspects that, of course, make the framework, if you like, overall more complex, because it's more comprehensive, so it's bigger in a way. But to us, it would be very important that they work also, and they envisage, sorry, that indeed the perspective is from a double materiality perspective, and maybe not only focusing on the impacts on the company. But I think that would be kind of the big issues that might be interesting for you to know from our side.
Thank you very much.
Okay, I saw Diana, you hand raised, then you took it down, so.
I'm all set. It was, okay. You've answered it, yep, which was some additional context. Yep, thank you.
Thank you. Any other questions for Elena? Well, Elena, it's been great having you on the call. We look forward to interacting closely with the Commission on this important work stream for ourselves. We're about to hear from 3 guest speakers shortly. You're welcome to stay if you'd like, but we understand if you have other engagements this evening. So we just a real thank you for being with us today. And
yeah,
forward.
I'm afraid I have to leave, but thank you so much for the invitation. Thank you.
Okay, great. Okay, so that was really good scene setting for the policy making world. And we're gonna now get some perspectives from the investor, preparer, and accountancy profession now. So we have 3 great guest speakers, Neil Morris, Jessica Fries, and Carsten Stendevad. And I'm going to turn it over to Lynn to introduce our speakers and that they're going to speak, and then we'll have a discussion to follow. Lynn?
Thanks very much, Tom. And can I individually and collectively welcome our guests. It's great to have such an impressive group of people leading this initial discussion for us before we go and talk about particular issues that we might consider in terms of moving this work forward. I'm going to introduce all 3 speakers up front, and then they will move one after the other through their presentations, and we will have a time to take questions between them as well. So the first person we're fortunate to have here is Jessica Fries. Jessica has overall leadership responsible for A4S. She's been leading A4S since 2008 and has worked with the finance community to lies a shift to a sustainable economy, with a focus on practical actions and targeted interventions capable of achieving global change. In addition to her A4S role, she is currently a member of the International Integrated Reporting Council Governance and Nominations Committee, the Smith School of Global Sustainable Financial Advisory Council, the UN Global Assessment Report Advisory Council, and the Global Reporting Initiative. So it makes Jessica extremely well qualified to be with us today. Our second presenter is Karsten Stendevad, who joined Bridgewater in 2017 and serves as the co-CIO for sustainability, overseeing Bridgewater's overall sustainability investing effort, including the design and oversight of investment solutions with both financial and sustainability impact objectives. He is also a member of the Operating Committee and co-chairs Bridgewater's Sustainable Investing Committee. Karsten is a board advisor to GIC and their Investment Strategies Committee, a board member of Nova Holdings, and a board member of the Danish Recapitalisation Fund. So we look forward to hearing from the investor perspective. And finally, but by absolutely not least, we have Neil Morris. Neil is currently the Global Head of Assurance and ESG Methodology for KPMG International. He has extensive experience in sustainability, ESG assurance, heading up the KPMG South African climate change and sustainability practice from 2010 to 2017. In this time, he gained experience on sustainability insurance in many industries, concentrating on financial services, including many of South Africa's largest listed banks. In addition to his roles at KPMG, Neil was the past chairman of the International Integrated Reporting Council Assurance Technical Collaboration Group, chaired the IRBA's Sustainability Standing Committee, and was a member of the South African Integrated Reporting Working Group responsible for drafting the discussion paper framework for integrated reporting and the integrated report. So welcome to all three of you. We really appreciate you taking the time to be with us. And the floor is now yours, Jessica.
Thank you very much, Lynn. And just to say, it's a real pleasure to be here. I first started working on sustainability assurance pretty much 2 decades ago when I was at PwC. In those days, there wasn't even IAASB 3000, I don't think, to use. So a lot of work to try and translate standards. So I think it's fantastic to see the progress being made and the focus that the IAASB has on this very important topic. Now, I don't know if I have 1 or 2 slides just to reinforce a few points. I don't know if it's possible to share those now. Fantastic. So if we can move to the next slide and the next one. So I'm going to really talk about three areas very briefly. Firstly, just touch on the timelines around sustainability reporting. I know that this is something that you've looked at before, and I think very helpful hearing from Elena the latest developments in the European Commission, but I think that sets an important context. I'll then go into much more detail into the work that Accounting for Sustainability AFRAS is doing on reporting. We work globally with all parts of the finance and accounting community. So particularly the CFO community across all parts of all sectors within the economy globally, but also a lot of work with regulators, accountants, and the accounting institutes, and indeed the investment community. But I'll focus today particularly on the insights from the work that we do with CFOs and finance teams. And then finally, just touch very briefly on the connection to financial statements and just reinforce a few of the trends that we're seeing and the discussions we're seeing in the market there. So moving on to the next slide. I think the key thing from this, the timelines won't be a surprise. We've just had the SEC sharing their rules around climate disclosure. The IAASB is due any time now to be releasing the first exposure drafts focused on climate. The European Commission and the EU is working at pace to produce sustainability reporting standards from an EU perspective. And then in other jurisdictions, you've clearly had an increasing focus on ESG and sustainability related disclosures, building on a long period of voluntary standards in many countries around the world, and in some cases, mandatory requirements connected to them. But I think that this diagram just really underlines that pace has changed dramatically. And over the next year, there is going to be a huge increase in the kind of demands placed on companies and preparers to disclose both climate and other sustainability related information. And a key thing is a focus on capacity and capacity across the market to be able to respond. We know that some of the issues, the information to support them and the robustness of that information is really key. Moving to the next slide. Within the A4S work with our global CFO community, we've been doing quite a lot of work looking both at that standard setting process and landscape, but importantly also the how. So how ready are companies and particularly finance teams to be able to respond as there is that increasing requirement in terms of the mandatory nature of disclosures in this area. And there are 4 areas that we've done some deep dives on and a series of roundtables and dialogues to understand how companies are currently responding and where some of the areas of focus and priority might be. And then from an assurance and an assurance standard setting process, I think that there are some clear connections. So firstly, governance. This is definitely an area that is evolving. So there's quite a wide range of approaches that organizations have currently adopted in terms of how they set the governance arrangements, all the way from which of the board committees might be responsible. In some cases, this is very much delegated to a sustainability committee. Increasingly, you are, of course, seeing audit committees starting to get more and more involved, particularly with that shift to mandatory. You are also seeing a real need and a response to upskill and build capacity in terms of sustainability related information and putting in place the right kind of knowledge base to understand the information that is being presented and some of the inherent challenges that might be very different to financial information. And also the breadth of the issues that an organisation might need to be reporting in the sustainability field is extremely diverse, and the types of information, the sources of that information range significantly as well. So there's quite a lot of different complexities within the information. You might have some that has pretty robust controls and processes in place, all the way through to others that there is a high degree of inherent uncertainty, a lot of assumptions being made to produce and disclose that information. You're also seeing that shift in terms of who is responsible within the organisation and a real process to clarify the roles and responsibilities from the board through to management and into the organisations. And again, sustainability related information often is an organization-wide process to collect and report that information. And so it really does rely on a broad set of individuals, many of whom won't be that familiar in some cases with the kind of controls that you might typically have in place over financial systems, won't necessarily have that akin type of training, and certainly won't in some cases be used to going through certainly a reasonable level of assurance. So I think quite a lot of focus there on that whole upskilling and really putting in place the right kind of governance processes. Secondly, materiality. Now you are seeing clearly from the different emerging reporting requirements, this question of what breadth of information is being reported, and of course using the language of the European Union has been talking about double materiality. So are you looking at information that is focused on enterprise value, aligned with the work of IAASB and others, or are you looking at that broader perspective of also wanting to understand the impact of the organisation on the outside world? This is an area that organisations have been grappling with for a long time, and certainly most organisations that have been undertaking sustainability reporting will traditionally have been using that broader impact lens. That's clearly the origins of a lot of sustainability reporting, very much focused on that broader stakeholder community. It is an important consideration, and it's one of the areas where we see some of the most diverse sets of viewpoints in terms of what people feel the priority and the focus should be. But of course, increasingly looking at that enterprise value lens and all of the regulatory requirements that you're starting to see, I think increases, again, the robustness that might be required over that information, and a clear role for assurance there. Data collection, again, some big gaps that people have been focused on here, and some of this also links to the scope of the information that is typically required and reported. And particularly when you look at climate data, there's a lot of discussion around scope 1, 2, and 3 data. So scope 3 really looking along the whole value chain, where the organisation clearly has less control, less ability to put in place robust procedures around that information, and a lot of work that organisations are doing to really understand the quality of the information they're getting through their value chain, using some interesting approaches, some of them technology-driven geodata, that sort of thing. It is a key area in terms of the kind of information that investors are asking for, as well as other stakeholders, particularly in that climate context, but not exclusively so. Something like human rights, there's clearly a very strong supply chain link as well. And then finally, of these 4 deep dive areas, reporting standards. So there has been for a very long time a real demand from preparers to rationalise the kind of standards that are required in terms of reporting, seeing the gradual convergence of some of the voluntary standard status under the IAASB, I think is a major step forward, but you are still seeing emerging differences potentially existing in different jurisdictions. So I think a very strong call from a lot of the preparer community to support global standards and the adoption of global standards, or at least aligned standards. So where you're talking about the same issues and the same reporting requirements, that the underlying standards are the same regardless of the different jurisdictions and the different needs of different policymakers in different jurisdictions. And that's certainly the vision of the IAASB. Moving to the next slide. So at one of our most recent roundtables, we really explored some of these barriers and some of the actions that could be taken with CFOs, with regulators, and with the assurance and investor representatives as part of that roundtable. a couple of things that I think would be interesting to touch on. And moving to the next slide, we did a short poll just to understand some of the views that people had around some of the key areas. And these really reinforce some of the points that I was making earlier. So firstly, interoperability, and that point on one standard and working collectively to that end. Secondly, the scope of reporting and the different views, but I think a high degree of consensus that you did need to be reporting along all scopes. There was quite a lot of discussion around whether the assurance should extend to all scopes, and I think that that's an interesting question of whether the assurance needs to be across all information reported, or whether there are subsets that might require assurance. I think that there are some concerns there around a focus being action, and will assurance of information reduce the amount of information that organisations will disclose? Now, clearly regulations have a role to play there as well. Materiality I've touched on, and then the other two, deadlines. So at the moment, one of the real challenges is that sustainability reporting often is produced not in line with the financial reporting period. So often after the financial accounts have already been disclosed. And I think that that does present some challenges, differing views, but mainly strong support that they should be aligned. And then in terms of assurance, strong support that there should be mandatory assurance over sustainability reporting, and that is really critical to build trust. Now, when we speak to a wider community of preparers, I don't think you see such unanimous support in terms of assurance, but I think that that is a very strong indicator of just how essential assurance is. And then finally, the next slide. Some key takeaways on some of the work that Accounting for Sustainability is going to be doing to support really putting in place the effective, efficient regime and helping organisations to respond. So we're doing quite a lot of work to be facilitating the dialogue, to be helping to share that voice of the CFO community and indeed some of the others that we work with, developing guidance, and the latest of our Essential Guide series will be focused on reporting. And then finally, that upskilling. So we run an A4S Academy, and I do think that that upskilling is really one of the key barriers, whether it's amongst the audit community, amongst preparers, amongst investors, amongst regulators. That demand for knowledge and the right skill sets on sustainability reporting is fundamental. And then the final point I wanted to make on the next slide is, of course, sustainability reporting and standards are essential, and assurance linked to those standards is really key. But there is also significant focus from a lot of the investor community and a growing momentum to really reinforce the point that they want to see climate-related matters connected to the financial statements as well. I know that this is something that the IAASB issued a staff practice alert on a while ago. Recent research by an organisation called Carbon Tracker highlighted that over 70% of some of the world's biggest corporate emitters hadn't disclosed the effect of climate risk in their 2020 financial statements. And they highlighted that 80% of their auditors showed no evidence of assessing climate risk when reporting. So that's a quote from their research. So I think that just underlines, and we're certainly seeing more and more active focus on this area. So I do think it is also important to continue to reinforce some of the existing requirements alongside building the requirements and the assurance around that broader information set. So thank you very much. Happy to take any questions that anyone might have now or after the other speakers.
Thank you very much, Jessica. We will hold questions until we've heard all three presentations. So we're already seeing some themes emerging, which is extremely valuable. So we'll now move on to Carsten and hear the investor's point of view. Over to you. Thank you.
Thank you so much for having me. I hope you can hear me clearly. It's a real pleasure to be addressing all of you. I was asked really to provide a practitioner perspective on the importance of ESG data, practitioner from the perspective of investors, who I think globally it's clear increasingly are using ESG data more and more in decision making. And really, I think the core message that I have for all of you is certainly speaking on behalf of the institution I represent, but also based on my very significant discussions with asset owners around the world, and even my own past as a CEO of a national pension plan in Denmark. The reality is that more and more investment decisions are clearly driven by or based on ESG data. And so therefore having quality ESG data, ideally, quality controlled by all of you is absolutely critical. I thought to make it a bit real, I would just, describe to you very practically how, from an institutional investor perspective, ESG data actually is processed and integrated into investment decisions. So I represent Bridgewater, which is the world's largest hedge fund, and we have a number of different portfolios that we run. All of them consider the importance of ESG to the extent that it's relevant for the risk of the portfolio or the return of the portfolio. And last year we launched really new types of portfolios that are explicitly focused on not just risk and return, but actually have sustainability as an explicit objective, sustainability impacts. In other words, the notion of double materiality. I think that in of itself, I would think maybe for you is a relevant dot of where the institutional investment community is going. The fact that more and more asset managers and asset owners are explicitly now starting to invest with two types of objectives, both of course creating great financial returns, but also asking the question of what really is the impact of this portfolio on the world. So this idea of I call it 3D investing: risk, return, and impact, or double materiality as the notion. I've been involved in sustainable investing for more than a decade, and it really is in the last just couple of years that the notion of double materiality has gone from, I would say, rhetorics and things that people talked about or were concerned about to something that is actually deeply integrated into investment decisions. If I just focus on these new investment areas that are explicitly focused on both financial and sustainability impact, today to do this well, of course, you as an investor really depend on quality ESG data. And of course, every day we can open a newspaper and there will be talk about the lack of quality of ESG data. But as an investor, you deal with the world you have, not the world that you wish you had. And so, in a way, until we get to the point where actually we are assured of quality data, what we have to do is to use the investment techniques or research techniques that we do in other areas when we're not sure about the quality of the data. Which is a number of things. Number one, it is, of course, to apply our own fundamental analysis to the question at hand. What that means is, as we look to invest in companies, of course, there's always, each company now has a narrative around their own sustainability profile. What we and I think increasingly most investors would do is to look beyond that, the narrative, and really narrow in on the hard facts. What are the hard facts that we can process in a way using our logic for what we think represents a way to capture the sustainability of a company, which may or may not align with how companies themselves describe their sustainability profile. In other words, we have our own fundamental mental map of this is what we think we would need to analyze for a company to understand their sustainability. Two, try to be very, very systematic about doing that so that we can have, in a way, equivalent analyses or assessments across a broad range of companies, really all in our case, all listed companies. And then speaking directly to the challenge of data, because we know that the quality of the data is not good, we need to do extensive triangulation of data. So I think in our case, maybe we have more than a dozen different sustainability data providers, sometimes actually looking at the same type of questions and metrics. But we really want to make sure that we have, in a way, because it's not always quality assured, we have to do this type of triangulation to give us some comfort around the quality of the data. We then also spend a lot of time thinking about really, in a way, what we would call like as an investor, you think about signal strength and the quality of the signal. In other words, do we think this company is sustainable? Yes or no? And B, how confident are we in that read? And of course, the better the data, the more confident you can be in your read. And today, the reality is, as an investor, you just have to spend your overall reads of sustainability. It's just you just have to factor in that the quality of the data is low. As a result, I think we use more than 200 different indicators for a particular company, and that really is, in a way, to compensate for the fact that each individual metric may not be so precise. Different investors rely. There's a difference in how much investors process raw data versus just use other, like, third-party assessments. It depends, of course, on the resources available and the investment styles of investors. Again, here we try to use really a combination. So with this whole ecosystem of sustainability data providers that's occurring, with the massive amount of data that's coming out from companies, we will look both towards, as much as possible, towards the underlying raw data, but of course also look at all the other players in the market who are trying to make sustainability assessments and see what they're saying versus what we're saying, and then seeing is there alignment, is there not. By the way, that is exactly how we would do it for any other type of investment research. I think one very important thing is, I think I already noted the point about not just looking at it from a financial perspective. Obviously, that's very important, but really also looking at it from this double materiality perspective. I really would urge you to take that route also. I think it's also I think it's fair to say that most investors have been most focused on climate metrics, driven very much, I think, by the success of the TCFD and other organizations to highlight the importance of that in investor portfolios. But I think from my perspective, our perspective, and looking across the world, we see very rapidly that other areas, I mean, the S and the G are as important, but it's true. But it's clear that the data is a bit behind there also. So I know you're debating kind of how narrow and how wide to scope your focus, and I would urge you to really focus on it widely, because I think that is where the world is going. And very quickly, the more as one starts to dig into the environmental sustainability of companies, immediately the implications on social issues come up. So it's very difficult to talk about clean tech without talking about labor rights. It's very difficult to talk about so this interdependency between environmental and social issues, I think, is very, very clear, even for those investors who say they mostly focus on climate. So I think that's where the world is going. I hope that's where the world is going, and I urge you to also provide that broad focus on it. I would then say that the I think, as the previous speakers noted, the importance, of course, of the harmonization of regimes is I think everyone agrees that is important, and also making sure that that the data is not kind of regime dependent, that there's somehow, even if it's presented in different manners, that there's a way of drilling back to the underlying raw data, and that becomes a regime independent. Again, more and more, if I think about what I think the movie will look like for investors, more and more it will be the way financial analysis is conducted, which means that some people will peel one layer of the onion, and other investors will do 2 layers, and some will do 10 layers. What would be the ones who want to peel it all the way down to the raw data, I think it's very important to keep them in mind, and not have it be, what I mean by one layer is like if it was very specific to an overall assessment or data that is put into one framework. I think that would not be helpful. So I think, like one would do with financial data, making sure that we drill into the really, for me, less about, it's really the quality of the raw data. For me, is more important than whether or not you would have assessed the overall company narrative around their sustainability. I think investors will have to focus on, at the end of the day, will have to make up their own mind about whether when they assemble the facts and the raw data, what assessment would they come up to in terms of the sustainability of these companies, as opposed to what the company's self-assessment is in their CSR or sustainability reports. So actually, let me just pause here. Mostly I wanted to just convey that the importance of the work that you're doing for practical day-to-day capital investment decisions by investors around the world, and therefore the criticality of the assignment that you have at hand. And my hope that you will define it in as broad a term as possible, really ideally in a double materiality context, and not and make it a non-regime dependent. So with that, let me turn it back over to you.
Thank you so much for that. And that theme of double materiality is definitely coming through from both of you. So interesting. And one of our challenges is obviously to look, do we go narrow or do we go broad? And we hear you about broad and investors. So many thanks for that. We'll now move on to our final presenter, Neil. And so while Neil's getting ready to speak, be prepared after this presentation to take the opportunity to talk to these 3 very well-informed people, and Tom will lead a discussion session with the 3 of them. So Neil, we look forward to your presentation now.
Thank you, Lynn, and good afternoon, good evening, good morning to all of you. I really appreciate the invitation and the opportunity to spend some time with you. In preparation for today, I really did scratch my head as to what I should cover in the allocated time. It's a broad subject. There are many things that we can delve into, and so I've chosen 4 areas that I'd like to spend some time with you on. Each will have some sub-bullets to them. The first piece is around the importance of the IASB strategic focus of being the globally recognized assurance setter in ESG. And I'll come back to that point. The second point that we've heard some pieces on already this evening is on limited versus reasonable assurance. I want to spend some time with you talking through where we experience errors, and highlight 3 key places where we bump into errors quite often. And lastly, I want to touch on this thin line between greenwashing and fraud, and how that plays out from an assurance provider's perspective. So let me start with the strategic focus area about being the globally recognized assurance standard setter in ESG. I mean, the use of ISA 3000 is already high, and that's because it's a good standard. ISA 3000 has provided a solid foundation, and many are going to tell you that it's not broken, especially those that have been using the standard for a number of years, that have got experience in delivering ESG sustainability assurance engagements. Their experience will enable them to fill in the gaps where some of the current guidance might be lacking. And also, the recently published extended external reporting guidance, I think that was really useful, and it plugged some important gaps that have been around. I mean, I regularly refer back to that guidance. But the needs of users of our reports, as we've heard already today, is rapidly evolving. And we're also seeing that more and more professionals are looking to provide assurance services. And this is the trigger that's driving the need for additional guidance standards. And since I began providing assurance over sustainability information, the use of our reports has evolved significantly. And as we've already heard, I mean, the robust challenge that's being provided through assurance processes today, that's now influencing where money is invested. It's influencing where people choose to work. It's influencing where people and companies choose to buy. And we know that high quality assurance reporting over ESG information will improve the disclosures. It's going to lead to better decisions being taken in relation to environmental, social, and governance matters. And that's going to be to the protection of the public interest. Fragmentation in assurance is a real risk. We hear about fragmentation from a ESG reporting frameworks perspective, and that drove the need for action. And those are ambitious plans that we see. And it's going to be really important from an assurance perspective as well. As much as it'll drive consistency and comparability in the reports, it's going to allow us to drive consistency and comparability in the assurance that we provide as well. I'd also highlight fragmentation as it applies from a regulatory perspective and a legal perspective. I mean, each regulation just adds a nuance to what's reported. It adds this change as to who can provide the assurance. And it just adds different nuances to what assurance standard should be followed. From an assurance perspective, there are any number of certificates and verifications that clients can obtain across ESG subject matters. And sometimes clients are requesting us to follow more than one assurance standard. And the idea that there's certificates and verifications in place already could be seen as a competitor to you or to us, or it could be seen as an opportunity for us to be able to place reliance on other service providers within this supply chain. What stands out to me the most, we need an international ESG assurance standard. And it's important that ESG is in the name of the standard, that branding is clear. It's clear then that the standard is for assurance over ESG information. I mean, quite simply, the name ISA 3000 revised, assurance engagements other than audits or reviews of historical financial information, it's long-winded. It doesn't specifically refer to ESG, and ESG information can include financial information. And it just triggers this discussion with your client as to, is that the right standard that you should be using? And it opens the door for them exploring alternatives. As an assurance practitioner, if you're able to report that we're delivering this engagement in terms of an international ESG assurance standard, it's simple and it's clear to the users of the report. I mean, another angle to this is the more granular guidance provided by IC 3410. Really helpful guidance. But what we do see is when there are two standards that you're needing to refer to in your reporting, it creates some complication. Now, I appreciate that there is a call for further guidance similar to ISA 3410, but I feel that this approach of addressing subject matters with standards that would require referencing in the report will add a complexity when there are 5, 10, 15, 20 indicators. That'll be an onerous referencing requirement within a report, including the subject matter guidance as an appendix to this new international ESG assurance standard. I think that may alleviate some of that challenge. I feel that an assurance standard on its own may not be sufficient. When I read through the agenda papers for this meeting, it's apparent that finding this balance between this immediate demand for subject matter specific guidance, as well as further assurance related guidance in areas like risk assessment, in sampling, materiality we've heard tonight, suitable evidence. What about the use of specialists? You've got a hard task. I mean, the current suite of audit standards, that wasn't drafted overnight. And it's going to take a lot of engaging with a number of stakeholders as you're doing to try and prioritize the key areas. Also, I wanted to highlight that whoever is providing assurance over ESG information, they need to follow international standards on quality management and international ethics standards. And they need to be subject to oversight and inspection. When independence, it's the first word of the assurance report. And it's critical that we have all 3 pillars in place to be able to provide this high quality assurance reporting that's going to be relied on for so many different elements of decision making. Let me move on to this limited versus reasonable assurance discussion. And we've heard some of that tonight from a few speakers. I mean, the reason for limited assurance being requested often relates to a few things not covered by the standard. It relates to the client having the budget. It relates to a timeline, or it relates to the preparer's confidence in the information. But we're not seeing enough of the needs of the users being considered. And that should be a key driver in determining whether limited or reasonable assurance is appropriate. I mean, currently we're seeing legislation that's being proposed where limited assurance is initially required, and then there's reasonable assurance in the future. And I do think that the evolution from limited to reasonable assurance is important, and ultimately reasonable assurance across all ESG information, I think, will become the standard. But more work needs to be done to manage the possible expectation gap that I think could exist when you really need to understand what limited assurance actually means. We need to make sure that limited assurance is meaningful. We need to make sure that it's addressing the needs of the users and that it's clearly more than inconsequential. I wonder if the confidence range as the limited assurance allows, if that's well understood. And determining the extent of procedures that are required in a limited assurance engagement, as a practitioner, it is difficult. Often, I wonder, what further tests would I perform if I was performing a reasonable assurance engagement? And that's how right up to the line we've been. And then in other circumstances, I see engagements that are far closer to the inconsequential line in terms of the evidence that they've obtained. I think the range in limited assurance is confusing. I think it's difficult for a practitioner to determine. And so do we really expect that the users of the report can determine the extent of assurance that they can take from the summarized procedures that are presented in the assurance report? I mean, the range available between inconsequential to just less than reasonable is wide, and it increases the risk of inconsistencies. Knowing more clearly what level of confidence can be taken from all limited assurance engagements on a consistent basis, I think would be helpful for practitioners and users alike. Let me turn to the third point, which is around where do the errors occur. Now, they could occur in a number of places, but I've drawn 3 points out for you. The first is around suitable criteria. I mean, to me, determining the suitability of criteria is where an assurance engagement has the potential to unravel. I mean, the guidance provided in the EER guide in this particular area has been well received. I mean, this is an area where there is significant judgment required, particularly while the standards are stabilizing. And this is an area where we know that the current reporting frameworks may not have provided sufficient detail. And so the clients have needed to supplement or alter the criteria to enable them to be suitable. And the standard is asking the practitioner to perform this work at an interesting time, which is before they accept the engagement. And this is going to require extensive work before you can take on an engagement. And then as a result, the enthusiasm of a practitioner can get the better of themselves. And the initial assessment could be superficial. And the criteria get truly tested only when the evidence starts being evaluated. And this is then when the engagement risk goes up and the likelihood of modified opinions can increase. We've heard about systems, the processes and controls, and it's common knowledge that in the area of ESG information, it's not as mature as you're seeing in financial reporting. ESG, it doesn't have a double entry journal system. The books, they don't balance. There is no goods received note when emissions are made. And completeness is always a risk. There's an area where practitioners need significant professional skepticism and judgment. And they're going to be truly tested when evaluating the sufficiency and appropriateness of evidence obtained in this sort of control environment. The last point of error that I want to highlight, I term in terms of unit of measure. There's a lot of discussion around the appropriate competence and capabilities of teams and the use of specialists. And this is true. And I derive a huge amount of value from engineers, environmental scientists, social scientists that form part of assurance teams. And as much as it's applicable for assurance teams to have these skills, we need to be on the lookout that our clients themselves are also investing in the specialist skills that they need in the ESG areas. But often the most complicated areas might not have the material errors. These seem to come from things like units of measure. And these errors, they crop up in multiples of 1,000 or tens of thousands. This is where we've got liters versus megaliters. We've got kilowatts versus megawatts. We've got carbon per ton versus carbon per kilogram. And it's the unfamiliarity with the information. This is new information that doesn't have comparators, run in Excel spreadsheets. And these types of multiple errors can easily crop up. The last topic I promised was around the thin line between greenwashing and fraud. Now, when you go and explore that fraud triangle for ESG, and as this becomes more mainstream, there are increased incentives, opportunities, and rationalization for companies and individuals to exploit ESG efforts for their own advantage. I mean, already there are ESG incentives and pressures. We see it from financing requirements. We see it driving company value. We see director remuneration linked to it. There is compliance, which has your license dependencies attached to it. And really importantly, it is driving the ability to attract and retain your employees. Of the 3 points of a fraud triangle, opportunity is most closely linked to the internal control environment. We know that this is an immature control environment, and therefore that opportunity for ESG fraud exists. And then due to the way that some of the companies are structured at the moment, the distance from a sustainability function to the board is often short. And individuals have gone from being a sustainability practitioner to very quickly being involved in strategic decision-making. And in addition, ESG is loosely defined in organizations, could be vague. The methodologies are also vague, and this in terms of the standards of measures, and makes it relatively easily for individuals to rationalize and find positive arguments for the positions and the decisions that they've taken. So when we consider the developments in reporting frameworks, we look at the range of procedures for limited assurance and how errors can occur in this developing environment. The risk of fraud, it's an area that assurance practitioners may be needing some additional guidance. But as I step back and all of these things that I worked through before today's discussion, the foundations are in place and the IAASB is well positioned to respond to the global needs for the specific assurance standards on ESG reporting and to be the globally recognized assurance standard setter in ESG. That is really something which is worth striving for. So I really appreciate the time you've afforded me this evening, and I wish you all the best in the work and deliberations ahead. Thank you.
Thank you very much, Neil. That was partly familiar and partly new thoughts, so that was really very valuable. To all three presenters, thank you very much for your time. Thank you very much for your insights. I'll now hand back to Tom, who will lead us through a Q&A session with the board. Thank you very much.
That was really terrific. In fact, I was thinking of just having the three guest speakers write the standards for us after that. So problem solved. Anyone who'd like to begin to ask a question? It's not a bashful group. Isabel.
Yes. Hello, everybody. My question is to Neil. I may have missed it, but I did not notice in your presentation a reference to double materiality. Have you tried to issue a report using double materiality? Because you're not coming originally from Europe, so is it something you also see in some other parts of the world? Thank you.
Neil, that one's for you.
Yeah, the straight answer is I haven't tried. Originally based out of South Africa, I haven't been using double materiality in the assurance report. So something that I'm not as familiar with and needing to spend more time researching on.
Thank you. Lynn?
My question's for Neil as well. You mentioned the EER guidance and in particular suitability of criteria. And we've also got quite a lot in there about limited and reasonable assurance. Do you think it would be sensible and possible to extract parts of that guidance and make them into what you talked about, the international ESG assurance standard, or do you do? Okay.
Yeah, I think what starts off as guidance gets put into practice, and that's a really good testing ground to say, well, was this useful? Did it work? The preconditions is a good area. The suitability of criteria really good. I like how limited assurance was tried to be addressed, but I'd prefer if that window between inconsequential and reasonable was just narrowed down to a single point.
Thank you.
Thank you. Bill?
Thanks, Tom. And my question's to Neil also, but it covers what Carsten and Jessica said. The terminology, it's a very trite point, but you said, Neil, that the title of 3,000 isn't sufficient enough to be directed towards what you consistently called ESG reporting or assurance, whereas Jessica and Carsten's almost exclusively referred to sustainability. And I'm still struggling myself with the IAASB going with the term sustainability versus ESG. Just give me a bit more flavour about the confusion, or am I the only one who's confused about the usage of those terms and the breadth of those terms in practice?
Well, so I think it's an area that there is going to be broader confusion on. I do see sustainability as a term that has been wouldn't say older, but it would be more dated. Most of the work that we've been performing in the past has been sustainability. I think referring into ES and G, one's able to then articulate the environmental, the social, and the governance perspectives. We're finding it, I'm finding that there's more brand association with it in the market. ESG is more clearly understood than the broader sustainability perspective. And so that's where I'm seeing the ESG piece. Yeah, let me pause there. Perhaps there's some others that would contribute on that. But
yeah, maybe Neil, do you want to, if I add to? I mean, I do. They're different. So ESG comes from the investor world, which Carsten will be very, very familiar with, and in the investor context, it's something that was shorthand for the environmental, social, and governance dimensions, all of which are very different. I think you're actually in the investor world almost seeing a shift away from it in some sense. You know, it's still very much language used, but because it was just a bucket to put together a very diverse set of issues. But I agree with you, Neil. What I'm seeing is then it's starting to be used in the corporate world more recently, which I think is an interesting shift, almost as investors are maybe starting to use other terms. I would totally agree with your point, Neil, that having a word in the standard to give a signal is really key. And what I would suggest is that you seek to align that with the reporting language and the global standards that are emerging there, because then you will get that resonance between the two and that instant brand recognition. And just to add one brief point, Isabel, to answer or to talk to your question. Certainly what we've seen globally, I mean, double materiality is a new term, but in a sense, a new term for something quite old. So actually, I think more assurance has been delivered and is currently done on something that's akin to double materiality. I think the bit that is potentially more challenging and newer is actually trying to split the two. So looking through more of an enterprise value, narrower lens could potentially be more difficult, because a lot of things can very quickly become material from that perspective. And what's the spectrum of that, and then how does that link back to the financial statement? So I think in some sense that's potentially more challenging.
So Jessica, just clearly Carsten urged us to consider double materiality from an investor perspective. Is there a subtle urge for you to at least to compensate for that notion, even if it's early stages of global acceptance?
I would absolutely agree with Carsten's point. I think it's what investors are asking for. It's what companies are, responding to, and from their own perspective, needing to deliver on. And I think it is in practice quite hard to separate the two, because something can so quickly become financially material as well as material from an impact perspective. So I think it is again back to a question of what should assurance be over. I think that's potentially slightly different, and Carsten may have some strong views on that. But I definitely think from a reporting perspective and from the practice that companies follow, they absolutely need to be looking through a double materiality lens, and indeed are.
I think we've talked about limited and reasonable assurance, and Carsten, maybe this is a point for you. You talk about dealing with the data that you have and trying to triangulate it. I guess we talk about limited versus reasonable as different levels of assurance. Is there a sense to investors about the value of both? Is there a sort of a discount that you apply in terms of certainty that you would acquire with reasonable versus limited? How should we think about this as being a meaningful thing for you as an investor?
So for me, I think the most important thing is the fact that there's clarity around the quality of the assessment. In other words, the thing that's problematic is if there are numbers issued where we as investors, we don't really know, like how confident should we have in this number? There are a lot of these ESG or sustainability related data points where if I'm putting myself in your shoes, I almost cannot even imagine how you actually would go about certifying it. And that's in a way, the more I know that, the more I know, okay, this is the various levels of assurances that have been given. It's like I would imagine, again, I'm not an expert on the in your field, but I would imagine as long there's certain types of numbers where if it's possible, like let's say for scope 1 and scope 2 carbon emissions, where one would think, okay, that it should be able to be assessed to a high level of confidence. Maybe actually sometimes even that could be difficult, but where you think, okay, that number, I really know that one has been stress tested. Then there are other numbers where you think, let's say actually scope 3 emissions, where you think, how could you, we almost know definitionally that the quality of that data, and therefore the certifications or the assertions that you can make about that number, almost logically it would have to be a lower bar. I think that's okay as long as it's transparent. And then there might even be data where you say, well, this number literally has not been audited. And as long as we have clarity around the 3, and that the core numbers, the ones that can be where you can have a high bar, you have ensured a high bar, I think that's, in my world, that's a good outcome. And I think, putting myself in company shoes, we investors, we have a long list of things that we would like to know. And there are certain things. Let me give an example of, I think, also where the financial versus sustainability will start to blend. Can I just give an example? If a lot of the focus right now for the world is how will the world transition to becoming sustainable. So let's say in the case of a company, let's say there's a company that today is not sustainable. They're let's say car companies. So they have fossil fuel, combustible engine cars. They're investing in becoming in EVs. A very relevant information for us, and I don't quite know whether this would be financial or sustainability numbers, would be to understand what are the financial investment decisions made, for example, CapEx or spending decisions that are being made towards transforming the companies to becoming sustainable. So actually the numbers that I'm talking about here could be, for example, being like green CapEx versus like classifications of spending or CapEx. That's I would imagine that's a number that should be able to be like where you can apply your highest standards. We don't really want to have uncertainty around that. Whereas I understand if a company's biodiversity challenges, I understand maybe that's a lower bar. So in other words, I think it's okay that as part of your, again, I speak as somebody who does not really know your world, but I think it would be okay if you had different standards for different types of numbers. I could deal with that, and I would just incorporate that in my analysis.
Okay, Edo.
Yes, thank you, Tom. Actually, just listening to Carsten, I was just struck, and it's not my question, but I think the ability to provide reasonable versus limited assurance, or a different level of assurance on different type of information. Clearly, that has to do with the ability of the entities that produce the information, or to the extent uncertainties or other risks are surrounding that information. So it's interesting how that there's a role for all of that to be played potentially within one standard. But my question is more to Jessica. And Jessica, good to see you again after so many years. And you spoke about 30 years or so. Well, if I just look back at the company where we worked on together, there's clearly a evolution awareness, but also of ability of the entities, the companies, their accounting for ESG type information, a desire for governments and regulators. But I'm curious what your perspective is of the change of pace, or the pace of change and the robustness that companies are actually achieving towards producing reliable information, in the sense of, are they putting their controls up there? Are they getting to a place where we can indeed, to the large extent, provide reasonable assurance? Because and I may be biased here, but I see a lot of engagements being scoped in as limited assurance because the entities just do not have what it takes to allow for reasonable assurance. And I would hope that, and you have a better view of what's happening at the entities, that companies that you're advising on, is that progress needs to pick up quite a bit. And I'm curious what your view is.
Yeah, and I think that, I mean, there definitely has, of course, been progress. I am surprised that it isn't as much as one might have thought in a couple of decades, but I think you're seeing a very rapid evolution in the last few years. I think that there's a couple of points linked to that. I do think that it's dangerous to go down the route of thinking that limited assurance should be the option to go down because there are gaps or concerns around the quality of the data, because I think that could be really misleading from an investor perspective. In some sense, actually, the more questions there might be, the more a reasonable route might be more appropriate, because actually it's giving those levels of confidence. But I really liked Carsten's comments around, actually, you know, you're dealing with very different types of data sets and very different stages of evolution. So actually thinking through how to present that clearly and have that transparency around the inherent quality of some of the data, or the quality that is in place within that organization at the current time, I think is definitely something that would be something to explore, and I would definitely recommend that. In terms of where companies are at, I think it is a huge spectrum. So you have some who have really got some pretty robust controls and processes in place, others who really haven't. And I mean, you know, you definitely still see some organizations who wouldn't have anything approaching an audit trail in place, or an ability to put that together. For others, you know, they've really got very strong controls in place. But you also might have variability around the different types of data as well, depending on how that gets used internally and the extent to which you've seen that shift to investor demand.
Thank you. Warren?
Hello everyone, thanks Tom. Tom, I've actually got two questions for Carsten and one question for Neil. So Neil, if I could maybe just start with your one. With regard, you spoke about the distinction between fraud, or rather the distinction between fraud and greenwashing, and the different sort of fraud risk factors, which I found very interesting. And I'm just wondering, do you think that it would be necessary as part of an ESG assurance standard to sort of explicate the idea of the rational purpose of the engagement up front? Or should the rational purpose be assumed, and then the issue of sort of fraud and all of the other factors that might otherwise have informed the rational purpose sort of be taken into account instead when we think about things like risk response, risk assessment, etc.?
Yeah, so I mean, the rational response is part of the preconditions. So it'll be one of the preconditions to determine for accepting the engagements. It's actually the one precondition that doesn't exist in the AICPA standard. And so there is a difference where the rational purpose under those standards is assumed. I think I would probably need to reflect on it a little bit further, Warren. I'm hoping that the rational purpose becomes more assumed in this space, given the driving need for the disclosure and then the regulatory requirements around that, around assurance. And so the rational purpose may evolve to be one of compliance rather than in an area where it's voluntary and it could be used to manipulate, and therefore let me give this a veneer of accuracy by obtaining assurance over the information.
Okay, and Lauren, you wanted to come back on a couple of questions for Carsten?
Please. And Neil, thank you very much. That was a really helpful answer. Carsten, you spoke about the different layers of analysis and how the layers sort of seem to end or sort of culminate in what you called the raw data. And then you refer to the issue of the quality of the raw data and how challenging it can be to assess the quality of that data. And then you explained very nicely how you carry out a triangulation process, where you sort of have a look at different sources of information and sort of double check it to sort of gauge, I suppose, how valid or relevant the information is. Would it be possible to just explain in a little bit more detail how you actually determine the quality of the ESG information other than through that sort of triangulation process, or is it really just a case of triangulating with the information obtained from the third-party providers or from whatever other source?
You know, it's a combination of a few different things. So I would say the first thing that we would do is for all of our, so we don't collect raw data always ourselves. So we will, first of all, in collaboration with our data partners, as part of our due diligence with them, for all the areas of importance to us, we will really drill into with them, each of those domain experts, what they would view as the quality of data. So that's one thing we would do. And then we would, as I said, not only rely on one domain expert, but we rely on several. And so we would, very practically speaking, we would, for a particular data field or for a particular area, we really would use triangulation to see, is there a big disagreement? Not if it's precisely the same, but is it pointing in the same, like what we have to do, given that the data is not perfect, is that we at the end of the day have to make is it reasonable for us to think that this is, that this is true? These are like, they're at the end of the day, they have to be probabilistic assessments. And so I really would say it's a combination. I think I would really say of three things. One, our probing with the actual data providers and their expertise. Two, the triangulation. And three, a bit of a common sense point that we know that there's certain areas. Let me give you an example. Modern slavery. Modern slavery is an area where we know that's a very important topic. We know that investors increasingly have to actually certify in a number of jurisdictions, like the Australian, whether or not whether their portfolios contain modern slavery risk, whether really some of the holdings are involved in modern slavery. And this is a great example of where we know, I think my team and I, we've spoken to most of the data providers in the area. We have the data, we've used the data, and when we look at it, everyone agrees. Even when we speak to the companies, everyone is saying, we just don't, we have some numbers, we just don't think that they're very reliable. What that means is, I still think you can still use it for like order of magnitude. Is there an industry where this is very, 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 very unlikely versus likely? So you can still make some type of statement, but the statement you can make is, much weaker. And in that example, and Tom is, I think, is also involved in this area, in this work, is really to say, okay, we don't, if we really, neither through triangulation, nor through speaking to the experts, nor, by the way, by speaking directly to the companies, if we really cannot get comfort at any level, then in a way we really have a systemic problem. Then literally we have the challenge of how do we improve the actual quality of the data. And so then, you know, we have a number of initiatives underway that seek to then just literally generate the data. So that's I think that's how we would try to do it. And yeah, so you basically speak to the experts, you triangulate, and then at the end of the day, you speak directly to the companies and you hear what they have to say. You know, the task faced for companies is enormous. If you think about some of when it comes to even thinking through carbon emissions, if you're a big manufacturer, if you're an auto company, and you think about the number of suppliers that they have and the number of plants that the suppliers have and the number of jurisdictions, it is an enormous task that is facing them. And so that's an example also where even if all the data points in the same direction, you speak to the company and you realize, even if they've done as well as they possibly could, this almost definitionally must be a rough number. This cannot be a precise number because it's almost impossible yet to do it. So that's also ultimately the reality we live in. That okay, so we just always try to assess on a scale from, it's never going to be very precise, but if we have a sense of more or less of where it is, then we can use it in our systems.
Thank you very much. And then the second one, you explained the difference between.
I'm sorry to do this. We've actually are towards the end of our time here. So if it's a very quick question, and maybe Josephine, do you have a very quick question too? Because we need to conclude this section in the next couple of minutes if we're going to have enough time to deliberate afterwards. So maybe a quick question. I'll take Josephine's and then we'll conclude.
Thank you. And
Warren could have his quick question, and then we'll take Josephine. So
okay, right.
Yeah.
We didn't know.
It's not a quick one. Okay. It's a quick one. Let Josephine ask a question.
Okay, we'll get yours offline and maybe submit it later.
Oh no! Now I'm under pressure to make it really quick. Just first of all, thanks to all the speakers. Greatly appreciated and really, really interesting. Jessica, you mentioned, obviously I know we've met. You do so much outreach. One of the things I thought would kind of steer us slightly is if you have any sense of misunderstanding from the user's perspective of what's actually being delivered in terms of actually the audit engagement. So in a situation where there is so much being reported in the front end and there is only so much work that the auditors would do in relation to that work, and obviously integrated information is more complicated, but taking that aside, do you get the impression when you're doing all this outreach that there is some education that's needed on what is actually being delivered in a standard set of financial statements and front half with cross-references? Thank you.
So it's not something we've asked questions about explicitly recently, but certainly when we have looked at that area in the past, there has been an expectation that more has been done than is the case. And I think that that's something that has been an issue, a challenge for quite a long time. Of course, you have some in the user community who are clearly very well versed, but I think that that is probably a minority. And potentially, to Carsten's analogy, maybe that's those who peel back the layers of the onion to really get into the detail. I think others probably just take a very high level sense check, and I think that is a big risk. Coming back to that whole question of things like reasonable or limited assurance, I think, and the breadth of different standard setters, the points that Neil was making around, if you're looking at something like limited, what does it mean? There's such a broad range. I really think that the more that there can be clarity, particularly in this area, which will be even more challenging than in that financial audit context, I think is a really important point to think about.
Right, that's really helpful. Thank you. Thank you.
Thanks. And I have just a very quick question for Neil. You talked about the value of doing an ESG standard. I think if I read you right, it's not the question of standard or standards. It's the idea of having maybe a standard or a suite of ESG standards that are branded and dedicated. ESG is what's important to you. Or is it specific that you're thinking about one standard could do it all?
I think it'll be difficult to have one standard to do it all, but I do think that that's the starting point.
Yeah.
Starting with one standard and then picking topics, as we have done in audit, as to where more relevant specific guidance would need to be in risk assessment so that it's ESG specific. What about fraud, materiality, etc., and start teasing out one of those 35 audit standards. Which ones do we now need to start hanging underneath this one single principle standard? In the same way that you've used ISA 3000 as the umbrella standard, I would see an ESG standard as being the starting point, and then underlying that with specific guidance for assurance information, or perhaps subject matter information like 3410.
Okay, thank you. That's a good clarification first. So what I want to do is thank our guest speakers. All of them have been excellent and really have provided us a lot of food for thought as we go into our breakout groups. Before we break out, I just said thank you to Karsten, to Jessica, and to Neil for joining us, for giving so much of your time at so many different hours of the day for you. So thank you. I wanted to, before we close and take a break, to ask from a CAG perspective, Jim, if you had any reflections on the discussion.
Well, other than to say, you're talking about the ESG, other than to say the CAG has had a keen interest in this subject, and all these different aspects seem to be coming together at about the same time. So I think it's very good that we're having the discussion.
And Janine, from a PIOB perspective, any reflections you want to give us before we do roll up our sleeves and figure out what our next steps are?
Yes, well, first of all, I think that this is the momentum that we have this project, or you have this project to work on, as we also heard from the presenters. So very important project to bring this further. There's a real demand and need, and so taking a leadership role, I think, in developing an assurance standard for ESG information is key. What I take away from it is actually, there's also based on the questions that were raised in the issues paper. But I personally, my personal feeling now is that going for a standard, but also making sure you can act quickly on producing a standard that you can adopt. So using what you already have, but it's, I think, an open door. And that's all in the paper, and that's what we're going to talk about in the breakouts. But I also, through these presentations, I think we can see some options that are becoming clearer. I think what would be the best way forward, at least in my mind. But I'm also interested in hearing in the breakouts what IAASB members think of this and what their thinking is. But I think, I like to, for me, it's important that it's going to be a standard that everyone can use, so to say, whether it's an auditor or not. I think that would be important as well. So all those aspects, bringing that together is, I think, what needs to be debated in the breakouts.
Thank you. Okay, so I think we're gonna close the session on that's being broadcast on YouTube. I want to thank our guest speakers for joining us and really appreciate your help, and hopefully we could call upon you as we navigate our standard setting activities. So thank you again, Neil, Carson, Jessica, for all your input today. We're gonna take a break right now. Do not leave the Zoom, though. We will rejoin the Zoom and give an overview of the breakouts. And I'd say we reconvene at 5:30 my time, half past the hour. So 10-minute break.